Mr. Kumar Karwal, Managing Director, CFO with Emkay Global Financial Services, joins us live. KK, morning. Thank you for joining us. KK, what would you attribute this week's price action to? For the first time in many weeks, Indian markets have moved independently of the global environment.
I think the sentiment last week was very, very negative, and we were overly concerned about the poor domestic fundamentals and the way your commodity prices have crashed, the way gold and crude oil have crashed. I think it's taken the markets by surprise, and obviously the expectations are that if these remain the way they are, then there should be a positive impact on our current account deficit, fiscal deficit, and overall our domestic situation, fiscal situation may improve. And so we have seen a very strong relief rally which is in the last 2-3 days, and also thankfully, FII flows seem to have turned positive after almost 10-12 days of negative flows. So the key question to look at would be whether these FII flows which have turned positive yesterday, if they are sustained, then the expectations built up that the market's good trajectory could possibly be on the uptick for some more time.
Mr. Karwa, first a word on how would you approach IT now after the disappointment with regards to NIFTY. Today, HCL Technologies has performed really well, and again in the evening we would be watching out for TCS.
The thing is that there has been a lot of disappointment with the NIFTY results, and TCS and HCL Tech have delivered good set of numbers, not only in this quarter HCL Tech has delivered, but consistently if you see for the last 2.5 years, their numbers have been much more consistent. So I think there is a distinct possibility that where we have already seen the valuation gap between Infosys and TCS. So the thing would be that maybe investors would now tend to more get polarized towards the companies which have been consistently delivering. Having said that, Infosys at current valuations does offer a good trading opportunity, but I'm not too sure how many fund managers have got the additional appetite to buy into the stock.
KK, just about everyone on the street is convinced that commodity prices are down, current account deficit will come down, and macros will improve. Is it too early to bet on that?
I agree with you, because this has been a sharp downtick which has happened in the last 2-3 days, and it's still too early to take a call that whether it will sustain over a longer time frame. And as I said earlier also, I think it will be very important to see whether this is part of a global risk-off kind of a scenario. If that is so, then your FII flows will not be there, and that is a very important factor for our markets to grow. And also, expectations have been built up, but macros are important, but ground level realities also have to improve if your domestic economic situation has to improve on a sustained basis.
It's time to go all in when it comes to oil marketing stocks, names like ONGC, HPCL, BPCL. They are no-brainer buys now.
If you see the oil, all these companies have been reasonably strong of late, whether it is ONGC or Oil India, and obviously if you believe that crude oil prices will be stable to on the lower side, then your subsidy burden etc. should be positively impacted, and that should help improve the profitability. Plus you also have a trigger as far as ONGC is concerned in terms of your gas prices, which are expected to be repriced from next year onward, and ONGC could be a big beneficiary of that. So oil and gas companies seems to be on a very strong wicket as of now.
KK, what explains the kind of move that we've been seeing in the entire banking and financial pack? Is it expectation in terms of the NPA for the overall sector bottoming out come this quarter's earnings? Or do you think it's got to do with more in terms of what the market is expecting from the RBI to do, especially in light of the inflation cool-off?
I think there are 2-3 factors where because of which we have seen a decent uptick in the banking and financial services companies. Primarily, I think the expectations that post the lower inflation numbers and now with crude and also coming off, the expectations on an interest rate cut in the coming RBI policy in the first week of May, that is getting built up. I think, and also if you see the valuations of most of the public sector banks at least were very reasonable. So as far as expectations on NPA cycle bottoming out, I think it would be a very, very bank-specific kind of a story, whereby whichever banks have been aggressive in their provisioning earlier, probably they would possibly have incremental slower NPA growth. So I think all these three factors together have helped in this rally in the banking stocks.
Vicky, apart from oil and gold, the other buzzword is power. After the CRC order, many market participants are of the view that we could see some powerful power sector reforms. If that is your view, do you think it is time to put some money to work in some power utility names, some power producers, some power ancillary companies?
Yes, I think if you are a contrarian kind of an investor and willing to wait out for maybe more than 12 to 18 months, then the valuations of many of these power utility companies and infrastructure companies, etc., are at very, very reasonable levels. No doubt, every individual company has some challenge or the other in terms of either coal availability or debt, etc. But if you believe that solutions are being found and individual companies will be able to come out of the logjam that they are in, then for a contrarian investor, one who is willing to wait out for 12 to 18 months, they offer good investment opportunities.
KK, from a technical perspective, where would you say the near-term bottom is for the market? Do you think we've troughed out at that 5,400 sort of level, or is there a chance that we could test those levels again?
It's very difficult to say, but yes, as of now, what it looks like is that it's 5,400 on the lower side and maybe 5950 on the upper side. That's the range kind of that we are in. And based on flows, based on news flows and sentiment, we have been trading in that range. But having said that, the depth of our market is not so good, and so that's the key worry, that if there are any negative news flows and FII flows turn negative aggressively, then it's very easy for our markets to break this 5,400 odd levels. So I would be very careful looking at the FII flows. And similarly, on the upside, we have seen that despite whatever beyond 6,000, 6,100, we have not been able to grow despite robust FII flows. So my sense is that currently we are in a range of 5,400 to 5,950.
KK, are markets factoring in a poor show from Q4 numbers, or Q4 numbers relatively still have a scope to surprise us on the upside?
Sorry, Nikhil, I think you'll have to repeat the question. I lost the question.
Right. What I'm trying to understand from you is that, do you think what exactly are markets expecting from Q4 numbers? Because so far the 2 or 3 numbers we've got, they broadly are in line with estimates.
Frankly speaking, I don't think so. There are any great expectations from the Q4 earnings. I think more what clients are interested in knowing is what kind of commentary or what kind of outlook most of the corporates have for going forward. So having said that, sectors where numbers could be decent could be, IT was one where one of the companies has delivered a positive number, and again Pharma seems to be a place where we could possibly see some good numbers. And so broadly my sense is that portfolios are reasonably well aligned, and there are not too many expectations from this quarter earnings per se.
KK, FY13 was largely dictated and dominated by macro traders. Regional funds, they got allocations, and that money pretty much moved into 8 or 10 large stocks. When do you think classic stock picking will make a comeback?
As far as I believe that we have already seen bottoms of classic stock picking only, which has worked for investors despite macro flows, etc. But as we have seen within sectors, always it has been the stock specific which has given you returns, whether it is in IT, whether it is in banking or in FMCG broadly. So my sense is that flows, whatever flows are there, but bottoms of stock picking will be the rule of the day. Having said that, there have been sectors where we can possibly look at contrarian investing, and there where we have not seen great FII flows, there could be more opportunities.
Okay, KK, good chatting with you. It always is. Appreciate you taking the time out and joining us today on the show.